Good morning, good afternoon, good evening, folks. Michael Zuber, one rinse at a time, back with Jonathan Twomley. And I just got to ask, Jonathan, I got to tell you, I think the whole notion of a soft landing has left the building after that CPI print of 9.1 and now PPI of 11.3 this morning. The Fed's got to break stuff. It's got to break the economy. We've got to see unemployment go up. We've got to have a real recession. I actually think the housing market where I play, residential, in a year's time will be to blame for the recession, because I think transactions and liquidity and cash out refis is going to just all collapse. And I just don't see how we get out of this. This whole notion of a soft landing always seemed unrealistic. I think it's dead and gone. The Fed's got to go at least 75, if not a full 100. They got to raise in September. We could be over 3% funds rate by September, right? There's talk of being at 3.25 or even 3.5 by September, not December, September. What do you think of all this? What do you see out there?
Yeah, so after the most recent, CPI print, which shows that the most recent, rate hike has not cooled things down very much, or if at all, right? Then I think the Fed is going to come back and do another sort of shock and awe increase to try to rein this in. And especially since, as you said before, hit the record button, they don't meet again until September, right? They skip a month. Mm-hmm. So I think that they're going to want to, I suppose they can always have an emergency meeting, which would totally shock the markets if they did, but they probably don't want to do that. But they're probably going to go and just do a big, significant message sending rate hike, and to try to really, just tell the world like, hey, we intend to get this in hand, and the world's got to play along with it. So I think you're gonna see that, and I think frankly, the dollar, because of these interest rate increases, has gotten so strong against other currencies, right? Other central banks are going to have to raise rates, right? You've got you mentioned Canada raising rates by a full point. I was just in Canada a couple of weeks ago, and everything from an American dollar perspective was at a 20% discount because the dollar was so strong. The dollar has hit parity with the euro, which has only happened once before, and it's been like 30 years since it happened. The yen is at almost 140 yen to the dollar. It's killing me. I have a lot of yen sitting in Japan. This is killing me that the yen exchange rate is so high right now, so depending on which perspective you are, right? But it is, to the point where my wife and I have stopped talking about bringing the yen back over here.
Just gonna leave it there.
Maybe we should I was like, hey, maybe we should just be buying more yen, right? At this point, if it's so cheap, we should be sending money over there, not bringing money over here.
There you go. Mm-hmm.
So, but I think other central banks, the Bank of Japan accepted because they just seem to they can't figure out what to do other than just print money. The other central banks, I think, are going to start. They're just going to have to. They'll be forced to raise rates as well, and that will spread what's going on here around the world as well. So you're going to see more of a global economic softening or slowdown as a result, right? So I think the chances of a recession, of a Fed-induced recession, are pretty good at this point. However, I don't know. You didn't sort of define what you meant by a recession or how bad it would be or what a soft landing is. If you define soft landing as no recession, then I think that's not going to happen. If you define soft landing as mild recession, I think the chances of that are pretty good. And the reason I say that is because the jobs growth is still we're cranking right on jobs, and if you look at interest rates, everybody, if you said, oh, interest rates, you said, I'm not mocking you, but you said, oh, interest rates are going to be, the federal funds rate is going to be at 3%, in a couple of months. When you've been living in this ultra low interest rate environment, right, that sounds really bad. And there's been a lot of misallocation, or, what's the word, malinvestment, right? There you go. Mm-hmm. In a lot of things, because interest rates have been so low. And if you have been one of those people who has been allocating cheap money into risky stuff, when interest rates go up, you're going to be in a world of hurt. That's true. However, 3% federal funds rate is still historically cheap, right? So that's where I say the impact on the economy, I think, may be more muted, because as a general matter, money is at that level, money is still going to be cheap, right? Sort of if you look in, take the long view of it, right? It's only if you were one of those people who said, oh, I have this chart that shows interest rates since 1960, and it's only going in one direction, and therefore the next step is negative because look what the line is going down.
The line goes that way.
It only goes down, right? So if you're one of those people who's like made a lot of decisions based on the fact that like it can't go up again because you have this belief that it can't, well, welcome to reality. Like things change, life changes. What goes down must go up, and vice versa. So those people, who at the margins, I think, will be hurt very badly. But I think the overall economy will not take a huge hit as a result of this, because money is still pretty cheap overall.
Yeah. I think there's no question money rained down on fools. There's been the capital allocators, and these go from VCs to hedge funds to, everyone, insurance companies. The allocation of capital in an environment where risk is zero or nearly zero, cost of capital is zero, bad things happen. And when that goes for 2 years, it gets entrenched, and oh, by the way, bad choices get rewarded. Oh, look, I'm going to put everything on 17 and see what the roulette. Oh, I hit 17. Wow. I'm going to do it again. Dude, you got lucky. You got lucky with timing, and they stayed too low for too long. And this is a worldwide phenomenon. We talked about it this morning. Central banks around the world are raising rates. Some countries, I think, some countries have inflation, true hyperinflation, right? 9.1 is bad. True is probably 14, but some folks have 50%.
Well, yeah, like Turkey. Turkey has got like true hyperinflation.
Yeah, 91% or whatever.
Yeah,
it's pretty bad. And you're right. I think central banks around the world cut in unison when the world shut down. They didn't know what else to do, so they all did it together within a 10-day period. Now they're all starting to rise. And again, Canada came out bigger and a surprise move. I heard the Philippines did the other day, and I think the Bank of England's going to do something next week. It's bad capital allocators, whether you were investing in meme stocks or as we've talked about, LPs on bad syndications, you were doing Airbnb arbitrage. I think everybody who was a bad capital allocator is going to get punished here. They've already been punished, and I think more is coming.
Yeah, I mean, I think the two sort of poster children for bad stuff that people do as a result of cheap money being available to them is stock buybacks and crypto anything, right? And like crypto, in particular NFT, like NFTs, the ugly stepchild of crypto. I mean, crypto is the ugly stepchild. So the ugly stepchild's ugly stepchild, NFTs, right? I mean, the fact that people invested in stuff like that simply meant that they had money that they didn't have anything else to do. They couldn't figure out what to do with it. So they just threw it at this stuff. And then, hey, it was hypey and it made money, so they got lucky.
Do it again.
Do it again. But it was essentially like playing roulette.
And, you were doing red or black. You were picking numbers on the roulette wheel. That's
right.
That's
and you will see that now as that money dries up. This is why crypto is crashing. Never was an inflation hedge, because if it were an inflation hedge, if it were really digital gold, you'd see crypto spiking. But instead what's happening is people are realizing all that money was like the amount of leverage in crypto was enormous. And now with interest rates rising, people are, that source is dried up. Plus people are rushing to cover, right? So, because they're going to be,
well, you have real fraud, you have bankruptcies, you have true Ponzi schemes.
But this is the kind of stuff that happens in these like Ponzi schemes, whatever. They always happen when the markets are hot, right? Because everything is going up. It's believable that things are going up, right? People don't question it, and they're willing to throw money. And the rising economy can help the Ponzi scheme continue to go, right? But then as soon as anything happens, that's when these things unravel. And I think, and now, what's it's the Fed that's pulling on the thread, right, to make stuff unravel. And, that's going to be very painful. But I think, I've said this on this channel before, I think higher interest rates are actually good for the economy because, not 20% interest rates, but if you've got like, sort of 5, 6, 7% interest rates, that is a healthy level for the economy because it means savers get rewarded. It prevents people from allocating their money into stupid stuff because they can get yield doing safe things, right? It allows for capital accumulation, which is then investment capital, in equity investment rather than debt investment. Debt investment is just, I'm borrowing it, so it doesn't really matter. I'm throwing it away, right? Equity investment is like, I earned this money. I'm not putting it into something that sounds like a cockamamie thing to me. It's got to be a good deal, right? So I think equity investment is better than debt investment. And, in order to get more equity, you got to have more savings, right? So I think it's good for the economy. Yeah.
No, I agree. Well, Jonathan, it's always fun talking with you. Where can people find you? Let's highlight your Facebook group. It's something I'm a part of, and it's a lot of great stuff going on there.
Yeah, sure. So the Facebook group is called the Multifamily Investment Community. You can just find it on Facebook. There's a couple questions that you should answer before you have to answer them or I won't let you in. But please answer those questions before you try to join the group. And I look forward to seeing you inside there.
Awesome. Let him know you came from one rental at a time so he knows his time with us each week is worth it. Thanks, Jonathan.
Thank you.